The average property in the UK now costs 9 times the typical salary. The last time house prices were this expensive relative to average earnings was in the year 1876, nearly 150 years ago. Owning a home in Britain was once a goal many people could achieve. Today, it feels more like a dream slipping further away with every passing year. Young families are getting locked out, and rents are going out of control. This is no longer a housing crisis, but a ticking time bomb that now threatens the UK economy. If this bubble bursts, it could take down everything about the current UK housing market. So, how did the UK reach this breaking point? Well, stick around, because the real problem is far darker than you think. Let's get started. As of March 2025, there's been an annual price rise of 6.4%, which makes the average property in the UK valued at £271,000, according to the UK government's press release. In London alone, it was £552,000. What's more shocking is the ratio between workers' wages and the average property value. Back in the late 1990s, the average cost of a home was still around £59,587 and 3 times the average annual salary. Today, that figure is 14 times in London and the Southeast, and 8 times for the rest of the UK. Similarly, rents have never been higher than it is today. Data from Zoopla in December 2024 showed that the average monthly rent in the UK was £1,223 per month, representing a 7.2% growth in the last year. In London, tenants are now paying an average of £2,121 per month for a basic flat. So, for a young professional earning the median UK salary of £34,900 per year, that means over 70% of their take-home pay could go on rent alone. It is little wonder that housing costs are becoming the most significant expense in most British households today. But the increasing prices of rent across the UK are just one part of the storm. The persistent default in mortgages is also escalating as interest rates remain stubbornly high. After the Bank of England increased its base rate from 0.1% in 2021 to 5.25% by mid-2023, many homeowners who locked in low fixed-rate deals during the pandemic faced an unexpected shock when their terms ended in 2024. Monthly mortgage payments that were once £900 suddenly jumped to £1,400 or more and left thousands unable to cope. And as ordinary people drown in debt, a new player emerges to dominate the housing market: corporate landlords. These are not small-time buy-to-let owners. We're talking about the mega corporations snapping up the UK's entire housing development. In 2024, reports indicated that Lloyds Banking Group was taking steps towards becoming the UK's largest landlord. Why are they doing this? Well, more on that as we proceed, but housing is probably the safest bet in the financial market. People may decide to not buy luxury goods in a recession, but they will never stop needing a roof over their heads. Inflation eats away at debt, but rents rise with it, thus making property an unbeatable long-term investment for these large firms. As a result, small-scale buyers find themselves competing not only with one another, but also with corporations that have hundreds of millions of dollars in cash and access to low-cost credit. The growing concern of property ownership is sparking renewed anger across the UK, and frustration goes beyond just prices. People are feeling the system is rigged, and they're asking questions like, why should a basic human need be turned into a corporate asset class? But here's the real twist. This crisis didn't just happen overnight. So, how did we get here? There were times when buying a house in the UK wasn't a fantasy. In 1997, house prices were on average 3.6 times workers' annual salaries for UK residents. A young couple could realistically save for a deposit within a few years. By the year 2000, about 58.6% of people aged between 25 to 34 owned their own home. Fast forward to 20 years later, and that number has collapsed to about 39.1%. And for those under 30, it's even worse, as barely 1 in 5 has the capacity to buy a property so far. What changed? The answer could be summed up in one word: affordability. The gap between salary earners and house prices is getting wider every single year. The median annual earnings for full-time employees in the United Kingdom were approximately £37,430 British pounds in 2024, compared with £34,963 in the previous year. In 1999, the average full-time salary in the UK was £17,803 per year, with median earnings exceeding £20,000 per year in 2002 and £30,000 by 2019. Meanwhile, the average house price has increased from approximately £77,698 in the first quarter of 2000 to nearly £272,751 as of the second quarter of 2025. That's an increase so sharp that even saving for a deposit feels impossible for most young people today. In London, a modest home in zones 2 or 3 costs £600,000 or more and requires a deposit of at least £60,000. And it's not just in London. Even in areas like the northeastern region, affordability is worsening. For many, the only option now is to rent, but renting isn't a pathway to wealth building as it traps them in a cycle where saving for a deposit becomes nearly impossible. According to BBC reports, up to a third of millennials may face renting their entire life. For millions of UK residents, the idea of getting on the property ladder is becoming nothing more than a slogan from the past era. Instead of building equity in a home, more individuals are handing over a third or even half of their salary every month just to pay someone else's mortgage. Why does this matter? Home ownership has never been about just having a place to live. It has also been a source of security, wealth building, and a foundation for a stable middle class. When people get to the point of being able to buy a home, they put down roots, start families, and invest in their new communities. When they can't, a lot of things go wrong as they tend to move frequently, have fewer children, and feel more disconnected. In that light, their economic and emotional sense of ownership begins to disappear, and with it, a key pillar of British life. So, how does this happen? How did Britain go from a property-owning democracy to a nation where millions are on their way to becoming permanent renters? It all began with a radical shift in the 1980s and a policy that would change the UK housing market forever. Back in the late 1970s and early 80s, the UK had one of the most balanced housing systems in the world. A significant portion of the population lived in council houses, which were publicly owned homes built and maintained by local authorities. These homes were not just for people with low incomes, they were also for middle-class families, as they offered them stable and affordable rent. Private ownership was growing, and housing supply was considered healthy. In fact, between 1959 and 1988, approximately 7.5 million new homes were built across the UK, as both Conservative and Labour parties treated building projects as a national priority. Then came the election of the Iron Lady. In 1979, Margaret Thatcher became Britain's first female Prime Minister and launched one of the most problematic housing policies in modern history, the right to buy. This scheme allowed council tenants to purchase their homes at a discount, in some cases up to 50%, if they had been a public sector tenant for between 3 and 5 years. It became an instant success. Between 1980 and 1995, over 2 million such homes were sold to their tenants, and for many working-class families, this was indeed a life-changing experience. At first glance, this initiative created thousands of homeowners, giving people a tangible stake in society. But here's the problem: those homes were never replaced. Local councils were not allowed to use the money from these sales to build new social housing. Instead, the revenue went to the Treasury to reduce the national debt. While millions of council houses were transferred out of public ownership, the pipeline of new homes was drying up. By the mid-1980s, the number of new council homes being built each year had fallen off a cliff. In 1977, the council built only 120,000 homes, and by 1997, that number had decreased to just 1,400 units. Yes, that's going from 6 figures to barely a few thousand in 2 decades. However, this wasn't the only shift. Thatcher's government also changed a few planning rules and began dismantling rent controls, which had been responsible for keeping private rent stable for decades. Meanwhile, mortgage lending was deregulated as banks were encouraged to compete aggressively, making it easier than ever for people to borrow large sums. This resulted in the first big wave of housing inflation in the 1980s. The long-term impact of these actions was devastating as the UK lost its ability to build enough homes and sold off much of its affordable stock. As a result, millions who couldn't buy at the time were pushed into the private rental market, which was now free to set their prices. Fast forward to today, and Britain is facing a backlog of 4.3 million homes that are missing from the national housing market. Tackling the problem sooner would require building 442,000 homes per year over the next 25 years, or 654,000 per year over the next decade in England alone, according to the Centre for Cities. But the damage didn't stop with the Conservatives. In 1997, Tony Blair's Labour government came to power, and many thought Labour would reverse some of these policies. However, they instead doubled down on the financialisation of housing. Blair's team embraced the buy-to-let boom and introduced more tax breaks and mortgage products specifically for landlords. For the first time, ordinary people were being encouraged to buy homes not to live in, but to rent out for profit. This turned UK housing into a speculative asset, fueled by an increase in demand that drove prices even higher. By the mid-2000s, property ladder culture was everywhere across the UK. At the same time, banks were handing out sometimes 125% of mortgages, meaning you could borrow more than the property's worth. Interest-only mortgages were becoming more common, as landlords were now allowed to keep costs low while hedging against future price increases. For many, this appeared to be easy money, but beneath the surface, the system is becoming dangerously imbalanced. The supply of new homes continued to lag far behind its demand as local councils had little power to force development. And because property values continue to rise, successive governments have continued to rely on housing as a tool for economic growth, rather than addressing the underlying problems. But if you think the UK housing problem ends with politicians, you'd be wrong, because another bigger and powerful force entered the scene subtly and seemed to be threatening the whole purpose of public housing in the UK. For centuries, the UK housing market was dominated by smaller families buying homes and landlords renting out a few properties. However, that era is over. Today, the UK housing market has a new master called corporate landlords. These are giant companies with deep pockets and a business model built on one thing: turning housing units into high-yield investments. One such company is BlackRock, the world's largest asset manager, which controls more than $10 trillion in assets. If BlackRock were a country, it would be the third largest economy in the world, behind only the United States and China. And yes, it has eyes on the UK housing market too. Reports indicate that BlackRock and similar firms have been quietly purchasing homes across the nation. Their strategy is straightforward: purchase properties in bulk, rent them out at high prices, and hold them for the long term as inflation drives up their values. They're not alone in this. The UK's largest mortgage lender, Lloyds Banking Group, also announced its plans to move big in the UK's rental market, with a target of owning 50,000 rental homes by 2030. Another firm called Legal & General has also said it aims to offer 3,000 affordable homes a year in a bid to address the UK's chronic shortfall of affordable homes. And then there's Granger plc, which manages thousands of rental units and plans to add thousands more across major cities. So why are all these companies so interested in housing? Well, unlike tech stocks or oil prices, people will always need a place to live. Rents increase with inflation, but debt remains fixed, making property a reliable hedge against inflation. For corporations managing billions in pension funds or investment portfolios, housing delivers steady returns with minimal risk. The problem is what this means for ordinary buyers. When a large corporation walks into a developer's office and buys 100 housing units in one go, how can a first-time buyer compete? These firms often pay cash, skip mortgage delays, and sometimes even secure deposits because they buy in bulk. Meanwhile, a young couple scraping together a 10% deposit literally has no chance. However, the unfairness doesn't stop there, as these corporate landlords often enjoy tax advantages that individuals don't. An ordinary landlord might pay an extra 3% surcharge on standard stamp duty, while a corporation gets a cheaper deal per unit. Many UK residents don't consider this a fair game. They see their country sliding towards a rentier economy, where a small group owns the assets and everyone else pays to use them. Suppose housing is no longer a pathway to security, but a permanent expense. What happens to social mobility, family wealth, retirement planning, and the idea that hard work can buy a home? But more importantly, if corporate landlords now dominate the UK housing market and ordinary people are locked out, what happens when the system comes under unbearable stress? What happens if the bubble bursts? Waking up to the headlines that read, "UK property prices plunged 20% overnight" may sound extreme, but economists warn that such a scenario is no longer far-fetched. After years of relentless price growth, the UK housing market is sitting on what experts call a debt-fueled bubble. So what would a housing crash look like in the UK today? The first cracks would likely appear in the mortgage market. Interest rates, which hovered at 0.1% in 2021, now sit above 5% as of the last report, after a brief 5.25% increase for 2024. For many homeowners who locked into cheap fixed rates during the pandemic, those deals are expiring fast. When they refinance, their monthly payments often double or even triple in amount. Although arrears have been on the decline, according to UK Finance, the number of homeowner mortgages in arrears decreased by 2% in Q1 2025 compared to the previous quarter. However, if job losses also start to rise, something analysts fear as the economy slows, defaults will follow. Forced sales could hit the market in waves, further pushing down prices. Now, a fall in prices doesn't just hurt homeowners, it destabilizes the entire economy. Why? Because property remains the backbone of Britain's financial system. Experts warn that UK house prices may fall 20% amid mortgage carnage, wiping billions from household wealth and stressing the banking sector. At first, lower house prices means good news for renters. However, if landlords sell their properties in a panic or go bankrupt, the supply of rental homes could shrink, leading to even higher spikes in rents in the short term. For families already paying high rents over £2,000 in London, This would no doubt be catastrophic. What would the UK government intervention look like? Bank bailouts? Mortgage payment holidays? Tax breaks for landlords? Every intervention has consequences. Providing too much support to homeowners could anger renters. Propping up house prices could delay the correction the market desperately needs. Doing nothing could trigger social unrest. The terrifying truth is when a system this large fails, it doesn't just bring down housing, it brings down everything. Thank you for watching. If you've enjoyed this video, please hit the like button, drop a comment, and subscribe to the channel. See you in the next video.